Everyone's talking about rate cuts in 2026. The Fed pivots, bonds rally, growth stocks explode. At least that's the story. But here's what nobody's saying. Rate cuts don't mean what you think they mean. And reacting before you understand the context, that's how you lose money while everyone else is celebrating. I'm Ava, and over the next 18 minutes, you're getting a framework, not a forecast. 5 filters that separate signal from noise when central banks shift gears. No hype, no predictions, just clarity. In the next 18 minutes, you'll learn why rate cuts can crush portfolios just as often as they save them, the 5-filter framework for thinking clearly in an easing cycle, how to define your risk without chasing headlines, a checklist that works whether cuts arrive or not, one action you can take today to position intelligently. Let's begin. People hear rate cuts and think green light, buy everything. The Fed's got our back. The Fed cut rates 11 times in 12 months. From 6.5% down to 1.75%, and the S&P 500 down 13% that year, down another 23% the next year. Cuts started in September. Stocks rallied briefly, then collapsed 38% over the next 12 months. Cuts don't guarantee wins. They reveal what's broken. Rate cuts are a response to conditions, not a fix. The why matters more than the what. SAC asks, are cuts coming because inflation's under control and growth is stable? Good scenario. Or because something's breaking. Credit stress, recession risk, financial instability? Bad scenario. Check the yield curve. If 2-year and 10-year treasuries are inverted while cuts begin, that's historically warned of recession 75% of the time within 18 months. Monitor corporate earnings guidance. If companies are cutting forecasts as cuts arrive, that's a red flag. Read the Fed statement language. Recalibration versus emergency action. Words matter. Context turns cuts into either opportunity or warning. Which one are you in? But even if context looks good, there's a second layer most people miss, assuming all assets benefit equally when rates fall. Picture 2 investors in early 2019. Both heard cuts were coming. One loaded up on long-duration growth stocks, high PE tech names with no earnings. The other bought a mix, some value, some dividend payers, some short-duration bonds. Cuts arrived, tech ripped 40% in 12 months. Investor 1 felt like a genius. Then 2020 hit, COVID, volatility. That high-duration portfolio, down 35% in 5 weeks. The diversified one, down 18%. Growth came back, sure, but investor 1 spent 9 months underwater, panicked, sold at the bottom. The principle, rate cuts amplify duration risk. Long-duration assets, growth stocks, long bonds become more volatile, not less. Practical application, if you own growth/tech-heavy positions, check your portfolio's implied duration. Stocks trading at lift 30x earnings have roughly 15-20-year duration equivalents. Balance with shorter duration assets, value stocks, financials, energy, dividend aristocrats, 2 5-year bonds. Stress test your mix. If rates drop 1% but volatility spikes, what happens to your portfolio? Consider barbell strategy. Some long duration growth for upside, some defensive short duration for stability. Set position size limits. No single high duration holding above 8 to 10% of portfolio. Do you own duration on purpose or by accident? Now, even if your duration's dialed in, there's a timing trap waiting. Thinking cuts work instantly. Let's talk about a small business owner. Call her Maya. She runs a manufacturing company. 2023, rates are high. Her credit line costs 9%. She delays expansion. 2024, the Fed cuts. Her banker says rates are coming down, but your existing loan resets annually. You won't see relief for 8 months. Her suppliers still paying high rates on inventory loans. Her customers still hesitant because their financing didn't improve yet. By the time Maya's business benefits, 12-18 months have passed. Meanwhile, stock traders priced in the benefit on day one. Monetary policy works with a 12-24-month lag. Markets reprice immediately. Reality adjusts slowly. Psych, don't front-run the entire move in one trade. Dollar cost average into positions over 3 to 6 months as cuts unfold. Psych, watch credit spreads. If corporate bond spreads, BBB versus Treasury, aren't tightening within 90 days of cuts, the real economy isn't responding. Track leading indicators, housing starts, manufacturing PMI, small business confidence. These reveal whether cuts are working. Expect volatility. The 6 months after first cut historically see 15-20% intra-period swings, even in bull markets. Psych, maintain 6-12 months of liquidity. Don't be forced to sell during the lag period when markets are choppy. Are you trading the announcement or positioning for the reality? But here's where it gets interesting. Cuts change what wins, holding the same portfolio through the entire cycle. Imagine 2 friends, both invested in 2019. One owned a tech-heavy index fund. The other rebalanced every quarter, shifting between sectors based on rate environment. Cuts arrive. Tech friend gains 30% in year 1. Rotation friend gains 22%.
Tech friend gloats, then inflation comes back. Rates spike, 2022 hits. Tech friend loses 33%. Rotation friend loses 12% because she'd already shifted into energy, materials, healthcare by late 2021. Over 4 years, tech friends up 8% total. Rotation friends up 31%. Rate cuts favor different sectors at different stages. Early cuts, long duration wins. Late cuts, defensives and value catch-up. SARK early stage cuts, first 3-6 months. Growth/tech historically outperforms as discount rates fall. Psych mid-stage cuts, 6-12 months. Cyclics join, industrials, materials, small caps, as economic optimism builds. Late-stage cuts, 12-plus months. If cuts aren't working, defensives win. Healthcare, utilities, consumer staples. Monitor sector momentum. When financials start outperforming tech 60 days into cuts, that's often a rotation signal. SARK rebalance quarterly. Trim winners, add to laggards, maintain diversification discipline. What inning of the rate cut cycle are you in? And finally, the filter nobody talks about. Believing the story everyone's telling. Fed put is back. Cuts mean stocks only go up. 2020. Pandemic. Markets are doomed. 2021. Inflation is transitory. Buy everything. 2022. Inflation's permanent. Sell everything. Every narrative felt true. Every narrative was eventually wrong, or at least incomplete. Narratives drive short-term prices. Fundamentals drive long-term returns. Rate cuts amplify narratives until fundamentals reassert. Set trigger points. At what economic data point, unemployment, GDP, inflation, does this narrative break? Limit narrative-driven positions to 10-15% of portfolio. Let conviction bets stay small. Review monthly. Narratives shift faster than fundamentals. Stay flexible. Are you investing in a narrative or in a resilient structure? Now let's put this into action. Before you make any moves around rate cuts, run through this. Trend/context check. Why are cuts happening? Why are cuts happening? Versus hard landing versus emergency. What's the yield curve doing? Inversion depth, steepening speed. Cocker or credit spreads tightening or widening? Cocker what's the unemployment trend over the last 90 days? Risk definition. Cocker what percent of my portfolio is in high duration assets? Cocker time horizon. Can I hold through 12 to 24 months of lag volatility? Cocker what would make me wrong? Write it down. If unemployment hits X percent, or if spreads widen Y percent, I reassess. Cocker position size. No single bet over 10% of portfolio on rate cut thesis. Liquidity / buffer. Cocker do I have 6-12 months of expenses in stable assets? Cocker allocation 5 to 15% depending on risk tolerance. Fees cost drag. Cocker am I trading frequently and triggering taxes? Cocker Orsen Sapflexion Star Comp Labs over Docker Vorsen Siteteats Traders Farah Vorgen Al the Bay and Nova Ritavu or Docker. If rebalancing, am I using tax loss harvesting? Diversification logic. Cocker do I own multiple sectors, not just tech? Cocker mix of duration, short value / dividends, medium broad index, long growth. Cocker geography, US plus international exposure. Review cadence. Cocker quarterly review. Check if original thesis still holds. Cocker monthly scan, credit spreads, unemployment, earnings revisions. Cocker annual rebalance. Trim winners, add to laggards. Emotional control. Cocker limit portfolio checks to once per week maximum. Cocker automate monthly contributions, dollar cost averaging. Cocker no panic selling rule. If considering a move, wait 48 hours plus write down reasoning first. Here's what we covered. Context over cuts. Rate cuts reveal conditions. Good or bad. Duration matters. High duration assets get more volatile, not less. Lags are real. Markets reprice instantly. Reality takes 12 to run 4 months. Sectors rotate. What wins early doesn't win late. Narratives mislead. Structure beats stories every time. One action for today. Open a document. Write my 2026 rate cut thesis. Answer. Why are cuts happening? What am I betting on? What would make me wrong? Set a calendar reminder to review it in 90 days. That's it. Clarity over chaos. Next episode, the liquidity mirage. Why cash isn't really cash in 2026. See you then.